The Treasury market is creating quite a bit of volatility in the equity markets this week. It's Wednesday, May 21st, and this is Markets with Megan. If you like this podcast, please hit that alarm bell, share with friends, family, or colleagues. But today we want to talk about the action we've been seeing in the Treasury market and how that's impacting what we're seeing in the equity markets. This all started last Friday with Moody's, which is a credit rating agency, downgrading the U.S. Treasury debt from its AAA status. Now, when you downgrade any kind of debt, typically people will demand more yield in order to invest in that. And we've slowly been seeing yields rise. You combine that with what we're seeing going on Capitol Hill with the trying to get the Tax Cuts and Jobs Act extension passed, and you're seeing a lot of uncertainty on what that means for U.S. Treasury debt. Now, Moody's downgraded our debt because of the fact that our deficit continues to get worse, and there is no trajectory that looks better, and it doesn't look like we have much fiscal discipline either. So it downgraded its debt. This is the third rating agency to downgrade the U.S. credit rating. Now, what we've seen this week alone is because of that, 10-year yields are up about 10 basis points just in the past 3 trading days. 30-year bonds are up about 12 basis points. So you're seeing this impact more in longer-term yields. Now, we had the first test to the demand of our Treasury debt today when we got the 20-year bond auction. The Treasury issued $16 billion worth of 20-year bonds, and it came in at a yield of 5.047, which is the highest yield we've seen since they actually started reissuing the 20-year bond. Typically, when these come to auction, we've seen the yield come in below expectations, and this one came in above the expectations. So this is exacerbating this sell-off in yields, and it's spilling over into the equity market because equities don't like volatility in treasuries, and they surely don't like significantly moves higher in treasuries. As we can see today, we're seeing some of those interest rate sensitive sectors take the biggest brunt of this, things like real estate, utilities, but you're also seeing sectors like technology that have high price to earnings multiples that are also getting hit today. Now, this is still in the early stages. There's a lot that's going to happen between now and when this Tax Cuts and Jobs Act bill ends up coming for a vote. There'll be a lot of volatility from an interest rate perspective because of that. This is why we don't recommend investing in super long-term bonds. We do have a deficit problem. We have a net interest problem. That's going to materialize there in those longer-term bonds. Short to intermediate-term bonds are less sensitive to interest rate risks, so that's where we would focus in fixed income. That's all we have today. We'll be back with more Markets with Megan. If you want to see a history of our podcast, you can go to marketswithmegan.fm. Thank you.